The cost of money and how much the country has tonight.
The Dan Yorke State of Mind program is brought to you in part by Lookout Rhode Island and Takeo Comfort Solutions.
Yeah, so another in the interest rates, and how can we afford this? And our context, I think, needs to come flushed out here. There were times in the old days when we actually had 6 and 7% mortgage rates, and we loved it. But I'll tell you, the housing situation and all the other things that come from rising interest rates are, well, these things are tough right now, and there's degrees of stress depending on who you are and what stage of life you're in, that we ought to at least break down and understand before we just cry ourselves to sleep. So we should talk about that tonight. Also, the country is facing another debt crisis, another Clint Eastwood make my day moment between Republicans and Democrats over whether or not we raise the debt ceiling. And how does that really work? Tonight I have the chair of economics at URI to help us with it, and he offered his thoughts on a news story on Channel 12 earlier this week.
Federal Reserve Chairman Jerome Powell announcing interest rates are going up again 0.25%, bringing rates up to a range of 5 and 5.25%.
We on the committee have a view that inflation is going to come down, not so quickly, but it'll take some time.
Economics professor Liam Malloy says although inflation might be coming down, it's not enough for the Fed to stop boosting rates. Their target rate for inflation is 2%. Right now, it's at 5%.
It also says that the labor market still seems really strong. We're adding a lot of jobs. Despite these increases, as you said, we're back to sort of the highest point we were since 2007.
The rate hike comes after another bank failed on Monday. JP Chase announced they were buying most assets of First Republic Bank. Both Silicon Valley Bank and Signature Bank collapsed last month, and it put speculation on how the Federal Reserve would proceed with rate hikes.
The three that failed were in a very sort of unique position where they had a lot of really big deposits, deposits that were not technically insured, although the Federal Depository Insurance Corporation has sort of stepped in to make sure nobody has lost any money.
The Federal Reserve's focus is on cooling inflation while trying to curb a recession. In Wednesday's press conference, the chairman said he thinks it's more likely the economy would narrowly avoid a downturn, pointing to the resilient job market that has been able to withstand the interest rate hikes.
With that strong labor market, we're not going to see a recession. We're not going to experience a recession until that unemployment rate starts going up. So, I think it's still an open question, right? I think we'll are we going to have a recession at some point in the future? Yes, definitely. We always do.
All right, we're all done. I think you answered all the questions. Great to have you live. Thank you very much.
Thanks for having me.
And of course, we're rolling this show on Thursday afternoons. You'll see it on Friday night on Fox and on Channel 12 on Sunday, and the CW at 10 o'clock on Sunday. So I don't know what may have changed between now and the weekend. Maybe we could get another bank that has a little bit of a flutter. As we are speaking, PacWest Regional Bank had a little bit of a morning turbulence.
Yeah, I think all of these banks are in the position where increasing interest rates is reducing the value of the assets on their balance sheet because they have all these 10, 20, 30-year bonds that are paying 2%. Well, do I want to buy those 2% bonds, or do I want to buy new bonds that are paying 3, 4, 5%? Well, I'll take these ones unless you drop the price here. So all of the banks everywhere are seeing this problem. As long as they don't have to sell those bonds, they're good. But when deposits started leaving Silicon Valley Bank, when they started leaving First Republic Bank, that's when they really weaken, and the FDIC has to step in.
Any way for somebody like you who watches this stuff very closely to project whether or not there's going to be another one and another one? The Drudge Report today was just not my necessarily, it's a collation of news, right? And it's one of my many stops in research, had this red, and they're very dramatic, you know, with the 50% of Americans fear their savings will not be there. Which only guarantees that by the end of the day, 52% of Americans will, right? You know, tell me about how the more than layperson, the economics guru, can take a look at this and know, or can you?
Well, so I mean, the problem with bank runs in general is that they can be self-reinforcing, right? This is what happened in the early 1930s in the Great Depression. But what we've done since then is we insure deposits up to $250,000. So as long as you have less than $250,000 in your bank, you will be made whole should your bank fail by the Federal Depository Insurance Corporation. Now, that's usually fine for most people, right? Most people don't have $250,000 in the bank. If you do, you might want to put it in 2 separate banks because then you'll be okay. Where it's not so fine is for larger corporations that have a large need for cash, some large nonprofits that have a large need for cash. And so what the FDIC has done recently is basically say, you know, we're going to make sure that everybody gets made whole in these bank failures or the purchase of a bank like First Republic by JP Morgan. And I think that's introduced a little bit of calmness, but also a little bit of uncertainty, because if you have $5 million in the bank, does that mean it's insured now by the FDIC, or is it not?
Maybe not.
Maybe not, right? I mean, by the letter of the law, it's not.
And differently from the last big bank blowout, unlike last time when stockholders in banks were made whole by the recovery, stockholders this time are not.
They are not, right? So if you are an investor in a bank, I mean, I think then you need to be a little worried, and that's why we're seeing some of the stock prices come down for especially these regional banks.
The concept, Professor, of the idea that the government can stopgap and fill a $250,000 account, don't worry, no sweat, in perpetuity or at a level of largesse, that has a significant impact on this inflationary situation, because the Fed just starts making money again, right?
So the Fed has
or is this just an infinite
power.
ability?
So they have basically a unique, infinite ability to create what we call bank reserves. By buying assets from banks, they pay for them with bank reserves that they just create out of the air. And then those banks can take those reserves and lend them. So what they're trying to do now is actually take some of that money out of the economy by increasing interest rates, by, you know, some of this bank shakiness is going to weaken the banking system a little bit, reduce the amount of loans that they put out into the economy, reduce the amount of money in the economy, and then hopefully also reduce inflation.
You know, when you say a bank has got trouble, I think a lot of people have a real hard, myself included, have a very hard time conceptualizing. You know, is there a big vault with a bunch of gold?
Yes.
That
No, there is not.
now there's only a little pile, and that
Right.
bank's in trouble.
Right.
No,
And
it's all digital, electronic, in good faith.
it is, and banks don't keep all of your money, right? If they just put your money in the vault, they'd have to charge you a lot more to have a bank account, right? Because they'd have to charge for all of the infrastructure that requires. So what our banking system does is they take all those deposits and they say, hey, this is your money, you can have it whenever you want, but we're going to take most of that and lend it out to somebody else, right? It's the whole Jimmy Stewart, It's a Wonderful Life, you know, your money's not here, right? It's in Joe's, you know,
Right.
farm, whatever. So, and that usually that works really well, right? You have short-term deposits turned into long-term assets. It helps grow the economy. But when things get shaky, when those depositors get worried, that's when we can have problems, and that's when the government has to step in.
Any instinct as to how extensive the bank worry is?
Well, I mean, I think the problem for the Federal Reserve right now is that what they're doing to reduce inflation, which is to raise interest rates, is also the thing that is causing the banks to not be as solid as they would otherwise be. And so the Federal Reserve, you know, you saw in their statement yesterday, they said, you know, the bank system is strong, right? And you know, it's always a little worrying when someone comes out and says this is strong, because why are they saying that? But so I think they do have to balance, you know, how fast they increase interest rates, and I think that's one of the reasons that we'll probably see a pause going forward in the next 2 to 3 months before they decide what to do next.
So you raise interest rates, you put pressure on spending, the bank values on the notes they're holding go down. If they go down too far, you've got to come around the other side and secure the money underneath this process of raising rates. Do I have it?
Yeah, and so, and that's...
How do you draw that graph for your students?
Exactly. So, I mean, this is conflicting goals for the Federal Reserve, right? Because they both are in charge of monetary policy and the macroeconomy and banking regulation. And so they have to balance this. And so there's this question of what's sort of known as financial dominance, whether the Fed will, put the bank's interests in front of the macroeconomy. So far they have not, right? So far they have been increasing interest rates at what appears to be a fairly steep, pace. And what I think most economists would say is reasonable to try to bring down inflation. But as the banking system gets shakier, they are going to have to think more about that.
All right. When we come back, we'll take a look at what the Fed hike means to us as consumers. Stay with us. Yeah, so on this concept of the interest rate rise, so we just talked about the banking system because I think people are worried about that. Now it's a question of managing our own consumer issues here. And as you told me on the radio earlier this week, Professor, this manifests itself mostly and firstly and more prominently in mortgages. I can remember. I was saying after I let you go on the radio early this week, I remember digging through my parents' paperwork if they had passed and getting their stuff together, and actually my jaw wide open in 1970s home acquisition. The mortgage was like 12, 13, 14, and I remember them talking about refinancing when the opportunities came. So we've lived at 6% and 7% mortgage rates just fine.
That was and that was sort of normal for a long time,
right?
6%. And we've definitely gotten used to lower rates, and I think a lot of people probably refinanced in the last couple of years because rates were so low. But what we do see is that when you're building a new house, when you're buying a house, the higher the mortgage rate, that does put some pressure on housing prices. And that's probably not a bad thing, overall, because housing prices have gone up so much. But it does limit people's opportunities, and it also limits new housing construction. And so that's sort of the main channel through which these higher interest rates enter the wide economy.
And you think that's the hard economy, or what's the term
the real
you use?
economy.
The real economy.
Real economy, yeah. So that
building.
Right. And so, it's one thing if financial flows change, but if construction workers lose their job, if people don't build houses that they were going to build, that then translates into lower income. They're going to spend less money. That actually has real effects in the economy.
It also has, for folks who are holding on to their homes, that got spoiled by their 3%. They don't want the new mortgage.
Right. No.
They don't want the new
mortgage
at 6%. So they're not. So I told you this week. My neighborhood is a classic American neighborhood, and there's always 2 or 3, 4 homes up for sale. Nothing's for sale right now because nobody has the feeling that they can go anywhere.
Yeah. So I mean, you'd have to change mortgages, right? Because you'd have to sell your house, pay off your current mortgage, get a new mortgage. Prices have come down a little bit, so you're thinking, oh well, maybe I'll wait to see if they go back up. But definitely we've seen in the real estate market that inventory, houses for sale has decreased over the last few months.
But you said something as well, and that the idea that we're stuck on these 6 and 7% mortgages. Most mortgages are 30-year notes. You'll have a chance to refinance.
Yes, and I think that's important. And I think most economists actually think that once inflation comes down, interest rates, they might not go back to 2.75% like they were during the pandemic, but they'll probably come down to that 4% range. And so you will be able to refinance. And I think if you're planning on staying in a house for an extended period, it's very likely that you'll be able to refinance in the next 2, 3, 4 years at a significantly lower interest rate. There's of course some risk there, but
what's it doing to the rental pressure? The rental pressure is so extraordinary.
Yeah.
Young people, the kids that you're teaching in both undergrad and grad, are going to go out there, earn a living, I'm sure you'll educate them well, but they're going to be stuck between a rock and a hard place with their startup salaries, trying to figure out how they can afford to actually have a roof over their heads.
Yes, and I've heard from students, I wanted to be in New York, I wanted to be in Boston, but I
couldn't do it.
And I think that's one of the big pieces. And what we've seen, it looks like rental price increases peaked, but they were up, 10%, year over year. And that's a big hit, right? If you're in the same apartment, you're paying 10% more, or you just graduated and now, apartment rent is 10, 15% more than it was a couple years ago.
I mean, a $2,500 bill for a 1 or 2 bedroom apartment is something that I never paid that amount of money on a mortgage.
I know, I agree, right? And you look at these rental prices, and this is exactly right. It's higher than your mortgage payment. And it's like, just buy a house, but of course you can't do that.
When can we expect that that'll cool off,
well, I think
if at all?
I am not as optimistic about that as I am about interest rates. And I think really what we need to do is we need to build more, right? So we're seeing demand be high in places like Rhode Island, like Massachusetts, but we're not building enough to meet that demand.
Should younger people save and buy versus spend and...
I mean, it's hard to do. If you have a parent's, basement where you can hang out for 3 or 4 years, then yes, but not everybody has that, right?
Right, yeah. It's a big quandary.
It is.
The answer is inventory.
I think we need to build more. We need to build in places
Every
where
community
prices are
says,
going
yeah,
up.
sure, but no communities want it.
Oh, I
everyone
know.
voices, everyone chirps that they're all part of the team, but when it comes
Yes.
down to it, their town councils don't want it.
Right, and I think that's the problem, right? It's all about zoning, and we have to decide, okay, well, where are we going to build these more houses? Are we going to be happy with smaller lots? Or do we want to have a place downtown where we can build bigger and taller apartment buildings? But in a place like Rhode Island, with 39, towns and cities that each have a say about their local zoning, it makes it difficult.
In sum, on this economy, I want to talk about the debt ceiling in our next segment real quick, but in sum, COVID blew us up, right? Changed everything.
Yeah.
And we talk about that being a recession, but that was a weird recession too, because we were all sitting home.
Yeah.
Oh, I wasn't. I was, I didn't sit home, but a lot of people did.
Yeah.
And so they might have had, gas prices were $2, blah, 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 da, da, da.
Yeah.
But nobody was doing anything.
No,
it was a weird recession.
It was very weird. Usually recessions are caused by some weakness in the macro economy, right? We overinvested here.
And everyone's getting paid in recession.
Right. And in this recession was all about, stay home. We've got a public health crisis, so stay home and we'll make sure you have enough money. It changed what people bought, right? Because they weren't going out to restaurants, they weren't going out to movies, they weren't going out to a lot of the services. They were buying, goods instead. And it really did change a lot of things. It also changed work, right? We still have people doing a lot of work from home. That increases the demand you want. Okay, I need a house now with an office.
And in that, we flooded the economy with money, which is why, getting back to the top of the show, that's why we're in the place that we're in right now.
I think it is, right? So we did a good job of making sure everybody had, or almost everybody had, enough income to get through the pandemic. But we probably did too good of a job. And so that increased demand more than supply. Inflation goes up. We have to bring that back down by reducing spending. We're, I think, on the path, but we're not there yet.
Uncharted territory.
It is, definitely.
All the textbooks, do you have any anymore? But all of the lessons that you're teaching at the grad and undergrad level are all being adapted to what happened in COVID, right?
It's true, and we've never had a situation like that. I mean, I even think about like what would have happened in the 90s when I was a kid if we had this. There's no remote learning option. Would we have shut the schools for a couple weeks and then gone back and just accepted the cost? I don't know. But so it was a weird confluence where we could tell people to stay home, but now we're trying to figure out what that means.
All right. Now the government's trying to figure out whether we ought to borrow more. We will, but how close to the end do we get? Stay with us. Well, this is another 2 or 3 or 5 shows, and we'll check back with you, at least on the radio side, as this debate goes on. Listen, we've had debt ceiling, Clint Eastwood moments in perpetuity, in history, in time immemorial, whatever cliche you want to put to it. But now Janet Yellen, the Treasury Secretary, is saying, hey, June 1, looks like we got a little bit more bills than we do cash come June 1. We got to allow ourselves to borrow more money. The Republicans are saying they want some stuff, and the president saying this should be an independent conversation. Which is the better argument, and where do you think we'll be?
Well, I mean, I think we have a process for deciding how much we tax and how much we spend, right? That's the annual appropriations process that Congress does and the president contributes to. The debt ceiling is a little unusual. Goes back to 1917. It's basically
a little unusual, a little high too. $34 trillion.
It's
Thank
a
you
lot
very
of
much.
money, right? And so we're at a point now where there's definitely a strong argument to be made that the debt should come down, right? It's about 120% of GDP, which matches where it was at the end of World War II. And so there is definitely a strong argument to either do some tax increases, do some spending cuts, find some places to reduce that debt. I don't think the debt ceiling is the place to do that because we've already passed the bills and we're going to do it again in every year. So let's have that discussion.
But what is the leverage?
Separate. Well, so I think the leverage right now is that the Republicans control the House of Representatives.
But
right?
in general, if we don't do it on the debt ceiling, I only got a minute here. What is the other leverage, if at all, other than public opinion?
Well, so I think one issue is the amount that we have to pay on interest for our debt. Right, so when the debt is high and the interest rates are going up, the amount that we have to pay every year just to satisfy the interest payments on our debt are increasing.
But does Congress feel that pressure from us? I think we kind of watch it.
Does Congress feel any pressure from us? I don't know.
That's a really good question.
And I think Congress, they have to do this, right? That's their job. The debt ceiling risks too much economically to say, okay, we're going to have these crises.
And if they don't make it by June 1st, I got 25 seconds here, do you worry that we go right into recession?
I mean, it depends on how the Treasury handles it, right? They haven't publicized a plan. As long as they keep paying interest and keep paying off the Treasury bonds, then I think we might avoid a recession, but it just doesn't look good, right? And it's not going to fill anybody with confidence.
All right. Appreciate you on top of the game. So everybody got all that? Did you take notes? Is it a science or a craft, by the way, economics?
We're trying to become more scientific. Let's say that. There's more data now than there ever has been.
All right. Thank you. Appreciate it. A final word and we can back. Stay with us. Speaking of economics, gaming. More online gaming for Rhode Island. Highest source of revenue other than taxes, gaming. Not just Twin Rivers. Valleys, as we call it. Some expertise on that next week, and of course we'll see you on the radio weekdays 3 to 6 on WPRI. Thanks for tuning in. Good night.